Well, as we mentioned, investors and economists were discouraged, to say the least, by the Fed's commentary yesterday. We just heard from a trader a few minutes ago, so let's get the economist perspective. Under the innocuous heading FOMC statement recap, economist Stanley ripped into the Fed. He says the body is wetting the bed over a soft patch and that Ben Bernanke is far too close to the political establishment. Stanley is chief economist at Pierpont Securities. He's a former associate economist at the Richmond Fed, and he's joining us now from Stamford, Connecticut. Strong words, Steve. Thanks a lot for joining us. Appreciate it. You also mentioned several times in your commentary that the Fed is running scared or that it is panicked. I mean, given what you say are underlying economic numbers that are weak but not terrible, why is the Fed in this panic state?
Well, I think they're very worried about deflation. That's something that they've talked about quite a bit recently. It's very, for me, it's eerily reminiscent of 2003 when, same thing. We were coming out of a recession. We had a recovery. It wasn't as good as we would have hoped. And the Fed was very concerned about deflation. And they put a big scare into the market then, too. And I think that's exactly what's going on right now.
Do you think that the actions it announced yesterday are going to stave off potential deflation? Do you think deflation is even a real threat? There still is some debate over that.
Yeah, no, I don't think it's a real threat right now. I mean, obviously, if we do indeed get a double-dip recession, then it comes back onto the table. But what we're talking about right now is we're talking about a soft patch. Growth has slowed down. It was clearly better early in the year and has slowed up. But I don't hear anybody at the Fed saying there's a realistic chance of a recession. I think this is more a case of the Fed being extremely cautious, and in some environments that's a good thing. But right now, the economy is suffering from a lack of confidence, and for the central bank, to be as scared as they look to be right now of something that's most likely not going to happen, I think, is only feeding into that fear in the markets.
I mean, in other words, you think the Fed is making the situation worse?
I do, yeah. I mean, I think, one thing that you hear is, well, this isn't really going to do any good in the sense, buying securities isn't really going to do any good because you have all these excess reserves that are already sloshing around, not doing anything. And that's fair enough, but that's just the first order effect. And the problem is that you also have to look at the psychological impact on the markets and on the economy in general. And already you're getting a lot of people saying, oh, gee, what does the Fed know that we don't know? And again, that sense of fear that's already pretty palpable, in the markets, but more importantly in the real economy, I think is only going to grow based on the Fed's actions.
Steve, I'm going to quote you to yourself again from your report. You talk about how quantitative easing has not worked in the past, either here or elsewhere, and you said you can lead a horse to water, but you can't make him drink. So even though you have rates that are very low, that doesn't mean that you're going to have people lending money, and that's what's happened thus far. But does the Fed have a role to play is there anything the Fed can do at this point?
Well, I think in terms of conventional monetary policy, which is basically the provision of liquidity into the economy, there's more than enough liquidity in the economy. The problem is that the pipes are clogged. The transmission mechanism is not working exactly the way that it should. The banking sector is, at least allegedly, not lending when it should be. And, I think it might be debatable whether those potential borrowers who are squawking about not being able to get money, maybe they're not as creditworthy as they like to believe. But if we start with the assumption that, for example, small businesses are not able to get credit, providing more reserves into the economy is not going to address that. I think that's more of a regulatory issue. Perhaps the strictness of the regulators and overreaction to the sins of the past few years. If Chairman Bernanke and company might walk down the hall to the regulatory arm of the Fed and the other regulators and kind of rap them on the knuckles and say, hey guys, we need to get the lending machine moving again. Something like that, I think, would potentially do more good than just putting more reserves into a system that's already saturated with liquidity.
Well, I'm guessing you think there's little chance that's going to happen, Steve, right? I mean, you also mentioned that you think Bernanke is too close to the political establishment. So, I mean, you don't necessarily then have that tension that would allow Bernanke to come and exert that kind of influence, right?
Well, you know, I think two separate questions. On the regulatory piece, I mean, the chairman has made a point of saying that the Fed is doing everything they can to get the regulators to ease up a little bit. He talked about that extensively in his congressional testimony last month. So, you know, maybe we should give him a little bit of a half cheer on that one. I think what I had in mind in terms of being too close to the political establishment is, you know, my view, and I think the view of a lot of people, is that what really ails the economy is this uncertainty that's being generated by various government policies. We don't know what healthcare costs are going to look like down the road. We don't know what tax policy is going to look like. We don't know which industries are going to be put into the penalty box by the administration and Congress over the next year or so. And so businesses are sitting on their hands, and similarly, consumers, I think, are leery to spend because they're just not sure what the outlook holds. And Chairman Bernanke is taking, I think, a very beltway approach to this in kind of talking about things in very conventional terms of, well, fiscal stimulus is going away, gee, maybe we need to spend more money, when, you know, this is one case where I think the general public and the markets are kind of out in front of both the Fed and the government on this of, you know what, we've tried that, it hasn't worked, it's time to move on. And if we recognize that the root of the problem is this uncertainty, then I think the Fed could play a very positive role by accentuating the positive in the outlook, talking about the positive fundamentals.
Steve, just in 10 seconds here, if nothing changes, if we continue on this same path, regulatory-wise, legislatively, Fed-wise, what does economic growth look like for the next year? Again, just quickly here.
I think it's slow for now, and it starts to speed up very gradually as the uncertainty gradually lifts.
Okay, Steve, Stanley, thank you so much. Pierpont Securities,
my pleasure.
Appreciate your time.